Welcome back to the show. We're joined today by Steve Van Metre, the Bond King and YouTube superstar, as we're calling him. Steve, thanks so much for taking the time and joining the show today.
Steve, it's an absolute pleasure. I'm happy to be here today.
Yeah, another kind introduction from our boy Keith Dicker there of IceCap. So yeah, appreciate the intro here. But yeah, Steve, I wanted to, I've followed your YouTube show for a while. Obviously, you're known as the Bond King. I think that these are fascinating times in the rates market. And I know that, in the past, you've been sort of more on the deflationist side. I think so have I as well. I mean, if you just look at sort of debt and demographics, I'm kind of curious, what's your current outlook? What's your current view today as it stands? I know there's a lot happening with inflation. We've had rates markets selling off, central banks panicking and, not only in Japan, but in the Eurozone. How are you kind of looking at things today?
Yeah, that's a good question, Steve. So broadly, my deflation view hasn't ever really changed, which was obviously a mistake because the pandemic, with all the fiscal and monetary stimulus, really threw that for a curve. But it's not something we've really ever seen before. So it is very interesting to see all these supply chain issues. But if you look at what we're seeing now in the markets, I do believe we're going to see consumer prices come down. I think we're going to see rates come down. And a lot of people are kind of surprised to hear that we are kind of now at the point where a lot of people believe inflation is sticky, it's permanent, it's never going away. But reality shows us, as particularly in the past, is when demand comes down, well, obviously price is going to stop going up or maybe even come down a bit. And we're seeing a lot of triggers, particularly the equity market, because we look at it and it is really a good example of growth expectations, and particularly here in the United States. When you see the stock market goes up, you have this wealth effect. People want to go out and spend, buy fancier homes, more expensive cars, more, nicer vacations. Well, you take that wealth effect away and all of a sudden, well, their spending goes too. And we're starting to see that. In fact, there's a great relationship between retail sales data and the stock market. As it goes down, well, sales go down. And I think the same thing's true with real estate, which is interesting because, they go, why does that even matter? Why would the stock market matter to real estate? Well, if I can't really afford the house I want to go buy, but maybe I actually have, decent net worth, well, I could sell some of my positions, or maybe I can cash flow off them, or I can go to the bank and say, look, I know I'm on the line here, but by the way, I got this money in the market. Or if I have a child perhaps that's looking at buying a home and they can't afford it, well, mom, dad could say, hey, look, we've done so well here, 30% annualized, we're getting rich. We can carve off a nice down payment for you and that'll help you out. So you see this wealth effect is very, very important right now, and that's being wiped out. And the central banks, particularly the Fed, has been very clear. Look, we're going to bring inflation down at all costs. We're going to raise rates. We're going to unwind our balance sheet. And you notice the market has responded in kind. And notably, of course, the Fed hasn't come out and said, hey, look, we think there's too much pain here. No, they said, hey, there's not enough. You haven't stopped spending yet. So I definitely see that we're going to have lower consumer prices. There's a big function of that is going to be in the gasoline space. We need to see gas prices come down for the CPI to come down. But as demand falls, I expect both housing prices to come down, the market to continue to come down, interest rates to come down, inflation to come down, and the deflation story to finally have its final hoorah.
Yeah, no, I think that's a really good point. Obviously, I'm here selling real estate in Vancouver, which is kind of the land of the ultra rich and the ultra levered. And so, what we saw in particular, what I see with a lot of my young clients is that so much of these down payments, I would say at least 9 out of 10 first-time home buyers are getting significant help from mom and dad. And that's because mom and dad have usually built up large equity positions, not only through their real estate, but through their stock portfolio, et cetera. And I think we're certainly starting to see the first-time home buyer retrench. But it is interesting because we have this dynamic right now where the segment which has been most impacted is that sort of more that young family segment, because they've seen their mortgage rates go from, here they're about 2%, now they're at 5%. And so all of a sudden that house, has gone up by an extra $1,000 a month on your monthly payment. So that home buyer is retrenched, but we're still seeing a little bit, actually surprisingly, a little bit more strength is in that higher end of the market where the cohort of buyers are not quite as subjected to the cost of money But what I'm kind of waiting for that shoe to drop is, at what point do these ultra wealthy people start to say, you know what, I don't want to pay $4 million for this house. I want to pay 3.5 because my equity portfolio, is down 20%.
Yeah, and that's coming. I mean, and on top of that, you have to factor, property taxes are going to get increased. Energy costs are obviously going to be high this summer, possibly even high this winter. And all of these are things around the house, your maintenance costs, your landscaping costs, everything's going to be more expensive. And that's going to eat into consumers' pocketbooks. And the wealthy, as you mentioned, their spending is like almost completely tied to the equity market. So it goes down. Well, they're not going to want to spend that, like you said, the $4 million. They might not even want to buy it all. They might turn into sellers because they've got to, maybe cover some of their positions that they're upside down on, and maybe they need some cash. So there's a lot of factors there. The risk we have is what happens as price comes down, who can handle that, and where are the counterparty risks, who's out there that's done things they shouldn't have done and taken risks to buy that home, and now they're effectively getting a margin call on their property, don't have the cash, and next thing you know, you get delinquencies, defaults, and the whole pyramid thing comes crashing down. That's the big risk. And somehow Canada has just escaped all of that, right? I mean, you've had your housing prices have gone through the roof for too long, and everyone's like, it's going to blow up. Hasn't happened, but boy, if it ever does, it's going to be ugly.
Yeah, we've got a lot of debt here. I was going to ask you, I mean, how are you looking then? How are you looking at like wages in the labor market right now, right? Because everybody keeps saying, labor market's so tight. The next sort of shoe to drop here is rampant wage inflation. Obviously, I think wage inflation hasn't kept up in real terms. Do you have an outlook on that? Because we're also seeing you have that kind of element where you've got signs of a tight labor market. Then you've got some of these larger tech companies now announcing some job layoffs. Obviously, these companies in the crypto space and stuff like that. So how are you looking at things from that lens? Like, do you have a view of like wage inflation picking up, and does that sort of keep some of the deflation story out of it? Or are we still, hey, listen, wage growth isn't going to keep up and we're at the beginning of a lot more job losses coming?
Yeah, wage growth is not going to continue to run. I mean, right now, inflation-adjusted wages are negative here in the U.S. And again, it comes back to people like, well, inflation can come down. Well, look, if you can't buy all the stuff you used to buy because your wages aren't keeping up with inflation, even though you got a raise, but prices are going faster, your spending is going to fall. And that's really the key point that we're seeing here. And in terms of businesses, we just got a lot of data out of the regional Fed manufacturing surveys, and it's showing new orders are declining. And this is interesting because it doesn't have a one-to-one effect with employment, but it has a lagging effect. So, I like to tell people, so let's say I had a business and I was selling widgets, and I hired all these people because, it's demand or perceived demand for widgets. And so I put all these orders out for new widgets, I hired people to sell them, and next thing you know, it's slowing down. So what am I first going to do as a business owner? Am I going to fire people? No, of course not. That doesn't work that way. The first thing I do is I cut back my new orders because I need to work through my inventory. Now, if at some point that cut of new orders, which we're seeing now in the data, doesn't let me work through my existing inventory, then I'm going to start laying off. So what you'll see is as new order demand goes down with a lagging effect, you start to see an increase in initial unemployment claims. And there's no doubt, like you said, Steve, you're seeing all these tech companies starting to lay off. Yeah, a few hundred here, a couple hundred there. It seems like, it's not that a big deal, but it's an early sign of what is to come.
Yeah, I feel like it's like kind of like common practical sense, like as a business owner, like the last thing you want to do is like, it took you some time to sort of get those employees, to train them. The first sign of weakness, you're not going to, okay, I'm going to lay them all off or lay this person off, because, you've already spent all that capital and time to sort of train them. So you're going to try to sort of, I think, ease through it, get through it. And then your sort of last resort, unfortunately, is to start laying people off.
Right, because you have absolutely no choice, because now you have all this inventory you can't move. And we're seeing that Walmart, Target, other companies are coming out and say, look, we have too much inventory. Not only do we have too much, we bought the wrong inventory because we thought people were going to buy this stuff, and turns out the economy reopened and now they don't want it. But don't worry, we've got even more inventory coming that we probably overordered because of supply chain issues. And as this stacks up and people don't buy it, the natural effect is you're going to see layoffs because demand goes down. I mean, if I've got 3 people in my showroom selling widgets, but I'm only selling enough that maybe I can afford 2, I have to get rid of one. Or if I'm only selling 2.5, I get rid of one and say, hey, guess what? The other you 2, you get some overtime. But reality is demand is slowing down. And that is one of the key points. As we see demand slow down, we'll start to see employers lay off because, hey, why are you paying people to stand around? I mean, it doesn't make any sense. I used to work in the mortgage industry a long, long time ago, and it was very interesting because the owner of the company, he had no problem laying people off. And then he had no problem hiring people. And because I had access to the CEO, I went and talked to him one day and said, hey, Howard, I don't understand. I work in the IT department at the time, and there was only 2 of us, so I was relatively not worried about losing my job. I said, man, I don't understand. It's like last Friday you laid off, this Friday, and then probably, and you did this. And he's like, look, Steve, the way the mortgage industry works is it's feast or famine. When it's booming, I can't get enough people. I hire like crazy. But when it dies down, if I don't fire people, he says, go around, on your way home, drive around this street, you notice how these mortgage places are closed? I said, yeah. He says, because they didn't get rid of people fast enough. And he's like, and that's how it works. Now, so that's the mortgage industry, but you think about the rest of the world and other businesses is what are they forced to do as demand goes down? You have to cut employees. You have no choice.
Steve, what's amazing is, again, obviously we're here in Vancouver, Canada, and Canada's notorious for having, rather toppy housing prices. And we had an incredible housing boom. We actually had record home price appreciation here. We had our home price index, which would be the same as your Case-Shiller index. We topped out at 30% growth on an annual year-over-year basis, I think in January or February. And then we're now decelerating on a rate of change basis. But it's interesting because pretty much every single bank that I've chatted with, most of them effectively doubled their mortgage staff over the past 12 to 18 months because they could not keep up with mortgage demand, right? We had a 14-year high in credit demand. And so it's like you said, I'm now kind of watching and waiting to see as housing volumes here drop 30 to 40%, which is what they're doing now, what that's going to look like for a lot of these people that literally just came on like 4 or 5 months ago.
Yeah. In the real estate industry is one of the first to get hit. I mean, here in the U.S., mortgage refinance applications are near decades low. I mean, layoffs have already started. There will be more. But you look at this, people that maybe became realtors 6 months ago or a year ago, they don't have the client base to rely on. They're going to go. I mean, and then you think about who's associated to that. Well, what about builders? Well, if you don't have people buying as many homes, you don't need as many people building them. You don't need as many inspectors. You don't need as many, cleaning crews. I mean, it starts to flow backwards, and you start to see why the real estate industry is really a good proxy. When the real estate industry starts laying off, bad things are coming for everybody else.
Yeah. So I was going to ask you, so I think you're relatively seems like you've got these things sort of tuned in, and I think we share a lot of similar views, but I think maybe our, head officials here at the Fed, the Bank of Canada, and what have you, maybe don't share that same view, or maybe they naively believe in their own stuff. But what do you think is the current trajectory for interest rates? I mean, again, we're talking about it was the Fed funds supposed to hit 3.5%, 4%. Same thing here in Canada. They're talking a 3.5% overnight rate by the end of this year, and I think we're at 1.75 or 2% right now. So we're talking about effectively a doubling of rates from here. I'm curious to get your thoughts on how you see things shaping up here.
Yeah, short-term rates should continue higher. I mean, I think the Fed's locked for July in terms of raising rates, and September looks highly probable, only from the standpoint is that consumer price index is a highly lagging indicator, one of the most lagging indicators out there. So I always like to tell people, well, why does the Fed get it wrong? I said, well, here's what I want you to do. I want you to get in your car and don't actually do this. And I want you to drive somewhere, and I want you to only look through your rear view mirror. I mean, completely cover your windshield. And I want you to drive there looking through your rear mirror, and you tell me how well you do, because that's what the Fed is effectively doing. But from their standpoint, they look at the number of job openings, which still is rather high. There's a big indicator for them. So like you mentioned before, labor market to them appears tight. That is a big factor. The second thing they're really focused on is oil. They need to see oil prices, gasoline prices come down. That is a big driver of inflation and inflation expectations. So central bankers are really trapped. They have to hike. They have to continue to tighten. And as we know from the past, it's going to blow things up. Now, from a rate perspective, this is where a lot of people get wrong. They think, well, the Fed's raising the front of the curve. That means the long end of the curve has to go up. It doesn't work that way at all. The long end of the curve is a function of growth and inflation expectations. So if growth is coming down, we discussed the market coming down, best proxy for growth. Well, when growth comes down, guess what happens? Inflation eventually comes down because people are buying less stuff. So we're starting to see some of maybe the early stages of the long end of the curve starting to peak and come down. And that would be actually consistent with the Fed actually raising the long end, coming down, saying, hey, Fed, you're making a big mistake. And then next thing you know, the whole front of the curve collapses and all the central bankers are back to, cutting rates and QE again.
Yeah, it seems like you've seen a bit of change recently in that long bond, the TLT, more recently. I don't know, how are you looking at that? Is this like, I know you can't necessarily give financial advice, and we'll put that disclaimer in there, but how is this in your view? Is this the time to strike on like TLT or
It's in the early stages of a bottoming pattern. I have a momentum report, a formula-based report that at the moment is still free of people. I think it's momentumtimerpro.com. There's a certain signal that it kind of hits that, I say, okay, that's kind of the golden signal. It's not there yet, but when I look at what it's telling me and look at the charts, it's telling me we're in early to mid stage of a bottom. But once this thing reverses and goes, rates are coming way, way down, and they're going to come down probably faster than they went up. And I think that's going to surprise a lot of people. But you look at what the Fed's doing, monetary policy is tight. The economy is rapidly slowing down. I mean, the data in June, May data, what we saw was pretty decent. And then all of a sudden June, we're seeing a complete reversal here. July, August, this thing's going to get a lot worse. And the part that a lot of people don't realize is monetary policy works with a lag. So a lot of these things the Fed's doing today often don't hit the economy for 12 to 18 months. So there's a lot of things to come, more quantitative tightening. And this whole picture to me says rates are going to come down substantially. Doesn't mean that'll revitalize the housing market, because as rates come crashing down, you know what else banks don't want to do? They don't want to lend. And so that actually, we could see rates come down just like the great financial crisis, and housing prices come down as well.
Yeah, so I was going to ask you that. How are you looking at the Fed's balance sheet these days? We only just begun, quantitative tightening. Are we back into a situation where, as you talked about, you start to get inflation coming back down, the economy goes into the dumps? Does that QE switch back on in 6 to 12 months?
Probably not. I think a lot of these policymakers are starting to realize what they didn't work in terms of the fiscal and monetary stimulus, and the Fed's really under pressure here. They got to bring inflation down from 8 to 2. So if they are just doing a normal tightening cycle and we're going into a relatively soft, even a mild recession, it's going to take time to bring that 8 down to 2. It's going to take an outright financial crisis again, which I think is very probable, and a deflationary crash to cause it to come down fast enough for them to change their mind. Still think it's possible. The question is, will they actually jump back on that, or will they be afraid to? You got to look at what they did. Their move is not popular. And a lot of people don't understand, why does it matter? It matters a lot, because when you have periods of high inflation and there's no answer for it, policymakers get removed from office. They're voted out, or in the case of the Feds, they're not voted in, but the people that voted, the policymakers that appointed the Fed can remove, when they get replaced, well, hey, these people are out, or we're not renewing their term. A lot of people lose their jobs. And so, with the midterms here in the US coming up, the established party, which in this case is Democrats, and again, we're not being political here, we're just being as a matter of fact, it doesn't matter who's in power, is during periods of high inflation, the poor and the middle class take the biggest hit. Well, if there's no answer for it, if my wages aren't keeping up, or the market's not keeping up, or I'm just not keeping up in any way, I'm going to vote out the established party. And then that leads to a cleansing of a lot of other people. So the Fed's under a lot of pressure here to not only to keep their jobs, and knowing that Congress is likely going to flip to Republican, and the Republicans are probably not likely to go back and turn on the fiscal spigots, because they just won, they'll effectively won an election on that notion, and they're going to say, look, we're not going to make the same mistake they did. So I don't know that the Fed runs back to this right away unless it's really bad, and it could be, because the challenge here is you start peeling back the onion and you have all these people that are posting collateral, right? You've got maybe in the crypto space or the equity markets where people posted collateral to buy stuff. Well, when they get margin called because the value of their collateral has fallen enough and they don't have the money to post, things start blowing it up. I mean, we haven't gotten there yet. If we do, watch out.
I'm looking at the crypto space, as an observer and, maybe a part-time player in that space. But, you got the whole story about Three Arrows Capital. I mean, you have some massive crypto lenders. I mean, you're talking like Celsius, BlockFi, regardless of what your views are on those companies. Those were like massive. I don't know if I'd call them, I'd borderline call them blue chip companies. I mean, Celsius had, I think, a $400 million investment from the Quebec pension plan here in Canada. So
yep.
I think that space is blowing up. It's just like, obviously, I don't think you have any sort of, there's no Fed put in the crypto market. That's for sure. I mean, they're probably happy to see it go. But what are the ramifications of that? And in your opinion, does that leak through into other parts of the financial markets?
Well, yeah, it's all a story of collateral, right? I mean, so let's give an example. Like, let's say I borrowed your car, right? And I didn't have the cash at the time. And I said, I'm going to give you these shares of stock or maybe some crypto. It doesn't matter. I mean, pick whatever you like, right? And you're like, all right, I'll accept that. I mean, it's equivalent value. And I've got your car and I'm cruising around and you're happy. You've got collateral. So if I, blows up, or I wreck it, you can sell the collateral and you're whole. Well, what if the collateral loses 50% of its value and I still got your car? You're going to call me up and be like, hey, dude, I either want my car back or I need some more collateral. I'm like, oh, well, I told your car, man, I'm shorting the market on cars. So I actually sold your car. I don't have it anymore. And you're like, oh, what? And so now all of a sudden I've got a problem because I don't have the money to post collateral to you to top you off. And I don't have the money to go buy your car back because I was shorting the market on automobiles. Like, it's stupid, right? But you think about it in a very basic scenario, that's how these big things blow up. Is because people post collateral, they're making big plays in the market, and next thing you know, and that's what we're seeing in the crypto space with Three Arrows Capital, right? Is people were lending money out or coins out, the market went down. Now all of a sudden, these firms don't have the collateral to make good on these loans, and next thing you know, you get delinquencies, defaults, things blow up, and the whole market goes. Can that happen in other places in the real estate market? Absolutely. So that's the risk is, you see asset prices come down. The Fed says, great, we're getting inflation solved. The problem is we don't know where all this risk is under this market. It's there somewhere and there's a line. And when it crosses it, we'll all know.
Yeah, I think that's a brilliant point because I'm kind of curious your thoughts. I think, in your view, obviously, and I think I share, again, a lot of similar views is that, we're on this trajectory for pain, right? I think the pain is already here with people struggling and I think we're inching closer to more pain and sell-off of financial assets. But how are you looking at fiscal policy? Because one of the things that we're seeing here, we're seeing in other parts of the world as well, is that these governments, especially in today's society where nobody wants to stomach any real pain, is governments just seem insistent on handing out, more helicopter money and saying, oh, you can't afford gas prices. Well, here's $100 check to go fill your tank. And so how are you viewing that? Because I think they're almost playing counterproductive to what central bankers are trying to do, right? They're trying to aggressively raise rates to kill inflation. And meanwhile, you've got governments handing people more free money.
Yeah, effectively you're vote buying, and it feels good, right? I can't pay for gas. Government sends me a check. Well, what it turns out then is everyone else raises their prices, but those prices don't come down as soon. And that's what happened, right? We had all this fiscal stimulus, prices went up. But once if you work for me, Steve, and I got my widget store and you're selling widgets for me and I give you a raise, I can't come back and say, hey, Steve, I'm sorry, but all that fiscal stimulus went away. So I'm going to have to take away that raise I gave you. And in fact, I may have to go below that. That's not how the world works. You're not going to do that. I'm not going to do that. So that's what people understand is you do these fiscal stimulus, prices are going to go up and they don't come back down. And then when that fiscal stimulus is gone, which we're at now, and of course, but a lot of states here are still doing that. There's still governments doing that, not so much at the federal level. what happens is we get back to the deflation story where people can't afford those higher prices and businesses can't lower them because their costs went up. And the only way the businesses can lower is to start to lay off employees, which of course then going back onto the state systems or whatever forms of support that are out there for unemployed workers. Well, their wages drop. And their spending drops. And then you get back to the deflation story. The only solution is you almost have to have a recession. You have to have a clearing out. The asset prices need to come down. But the problem is, and we saw this during the great financial crisis, is there's all this buildup of speculation and leverage. And when that breaks, bad things happen. I mean, we could do show after show on the Canadian housing market, how if it ever goes down enough, it's going to literally devastate the financial system of Canada. Mm-hmm. There will be nothing to stop it. And that's the problem with what these central bankers do. They inflate asset prices up. They finally got the inflation. They're like, oh, we need to bring this back down. But there's so much leverage support in all this. You bring it down and you can literally break the system. And that's what we're going to find out. I hope we don't, but I don't believe that at this point. I mean, it'd be different, Steve, if inflation was at 4, we're coming down to 2, or 3 to 2. Well, we're at 8, and maybe 8 going higher here in the U.S., and we got to come down. That's a long ways to go from a lagging indicator. I mean, you're talking bringing the year-over-year rate of change down. I mean, it takes a lot of work to do that. And asset prices have to come down. Leverage has to get unwound. And if it's not properly unwound, it becomes forcibly unwound. Back to our story of you decide you want your car back because you figured out I can't do it. And all of a sudden I'm like, well, I'm filing bankruptcy. And then all of a sudden, because you don't have the car and maybe you're an Uber driver or something where you need your car, well, now you're out of business. And next thing you know, you get this chain of people going out of business because all these collateral chains are going bust. That's the problem we're going to have.
Yeah. So for inflation to come down, I mean, I know that the Fed's talked about, well, we need to see, quote unquote, progress, right? And so for them, it's like, well, what is progress? So inflation comes down to 8. Is 6 palpable? Is 5.5 palpable?
No.
Is it 4? Is it 3?
It needs, they've been very clear. It needs to be on a downward trajectory. But again, this comes back to, we talk about this political issue and what happened, and the Fed was somewhat serious about this because there's one cure for inflation is over time, it will abate. I mean, you give it enough time, you raise rates a little bit, but you don't go too far. And I think Powell knew that, but he had a meeting with President Biden, and he kind of came out of that meeting with a renewed sense of, oh crap. Like, we got to bring this thing down. We got to do it quick. And it's almost like a midterm run of if we can bring inflation down, then all of a sudden Biden can come out and say, look, I brought inflation down and this is good for us. See, we did it and we're here to, keep us in office. I mean, I think there's a big play there because all of a sudden, all we've heard from the Fed speakers, and we heard some today, this morning, is, look, this is too high. There's going to be more pain. We're going to do more tightening. And the only question is how far do you peel back the onion before you get to the rot? And when you find it, it's too late. I mean, that's the scary part. It's under there. We just don't know where the line is.
I think we're going to find out, and that's that's the perfect way to wrap it up, Steve. I really appreciate you coming on. For those that are tuning in here, where's the best place for them to go check out your work? You've got the Portfolio Shield as well. I don't know if you want to give us a quick rundown on that as well.
Yeah, you can find me on YouTube at Metre, M-E-T-R-E, Stephen. It's Metre, Stephen, but my name is not spelled as most people understand. You can find me on YouTube. It's Steve Van Metre on the search engine or any search engine. Just put my name in. I do have a formula-based managed strategy, as you mentioned, called Portfolio Shield. And as a recording, I do have a free momentum screener that screens across 130 ETFs. Every day, looks for short and long-term opportunities there too. So, and some exciting things coming next week that we'll be excited to talk about. But I can't say anything. Can't say anything yet.
Can't say anything yet. So that's a little teaser for you guys. But go check out Steve's work because I know there's going to be a big public announcement. Probably at the time you're watching this interview, it'll probably be. If it's not announced, it will be announced in a day or two afterwards. So go check out Steve's page. As always, Steve, we appreciate you taking the time to come on the show and hopefully get you on again soon.
Steve, absolute pleasure. And thanks for having me on. I'll look forward to the next time.